Well, good day, everyone, and welcome to this Kaplan webinar on suitability. My name is Brad Charles, and I will be your instructor for this 90-minute class. I come to you from beautiful Milwaukee, Wisconsin, where it's a chilly 41 degrees with a little bit of rain. We're just thankful it's not snow. I was in the financial service industry for about 20 years altogether, and I had just about every job you can have in a sales office. But for the last 10 years, I've been with Kaplan, and I teach the Series 7, the Series 6, the Series 65, the Series 66, the SIE exam, life and health insurance pre-licensing classes, and property and casualty insurance pre-licensing classes. I've also picked up my MBA and CFP designation using Kaplan, so I'm also a satisfied customer. This webinar is part of a series of 12 free webinars Kaplan is offering over the month of April on topics that are common to all securities tests. For a list of classes and times, please contact Kaplan to get the latest updates. Due to the number of participants on this call, I will not be able to answer questions as we go through the material. Instead, my good friend Marie Sykowski will be our moderator for this class. Marie is also one of our webinar instructors, so she will be able to help you with whatever you need. However, we do ask that you limit your questions to the material in this particular class. For questions regarding other topics, we recommend you attend a webinar on that subject. They are recorded, so if you miss one, they are available to you on the Kaplan website. So, let's begin, shall we? Suitability. What is suitability? Well, it's really doing the right things for your customer, recommending the right investments for them based on their particular situation, their financial situation, their situation in terms of their lives, their age, their investment experience, their ability to understand certain concepts. A lot goes into suitability, recommending the right products for customers at the right times in their lives. And recommending unsuitable products is one of the fastest ways to get in trouble in this business. So FINRA, which is the organization that writes the test questions for you, and they are the organization that's kind of the big brother in the securities industry. They set all the rules. They are very, very conscious of suitability. So this is very important for you for your test, but it's also very important to you for your career in this industry. We always have to look at each client uniquely. Every client is unique, and we recommend a group of investments for that particular person based on their needs and their concerns. So everybody's unique. Recommending blanket recommendations for people is illegal. You cannot do that. Maybe there's an aggressive growth stock you're all excited about, and you say, everybody should invest in this aggressive growth stock because I think it's a phenomenal investment for them to be in. Yeah, you know, you've got clients that really shouldn't be investing in aggressive growth stocks. I spent most of my career working with the older folks. And I remember I had one gentleman that said he was so old he didn't buy green bananas anymore. So that particular investor should not be investing in aggressive growth stock. So like I said, recommending blanket recommendations is illegal. You will get in big trouble for that. So we got to make sure that we're recommending things to people that is suitable for their particular needs and their particular concerns. After this webinar, you should be able to identify the various investment vehicles that you can offer people. It depends on what kind of license you have. If you have a Series 6 license and a Series 63 license, you'll be able to offer variable insurance products, also closed-end funds, and you'll also be able to offer mutual funds to people. With a Series 7, you'll have a much wider range of vehicles you can offer people. So we're going to go through some of these that would be for being able to offered by Series 6 licensed people, but also Series 7 as well, because we know a lot of you are studying for the Series 7. And quite frankly, if you're studying for the SIE exam, there is Series 6 and Series 7 investments on that exam as well. So even if you're taking an SIE exam, you are going to have to know some Series 7 products, even though you may not be, going for a Series 7 license. So that's part of the reason why we're going to go through that for you today too, so you can see some of the investments that you would need to have a Series 7 in order to sell for those folks. So we will do that for you as we go along. Also, we have to understand the risks and rewards of different investments. With great reward comes great risk. People have to understand that they can't invest in an investment that's going to make a humongous rate of return with no risk. There is no investment like that. It doesn't work that way. The way it works is the more reward you're hoping to get from the investment, the more risk you're going to have to take. And risk can be different types of risks out there. If you were able to join us for our types of risk webinar that we did on Monday, we were able to go through some of those with you. There's a lot of risk out there. And risk goes hand in hand with reward. Low risk, low reward. You're not going to get a big reward for an investment that doesn't have a lot of risk. But if you're willing to take risk, your reward is potentially going to be much higher. So we will look at that as we go through these different investment vehicles to show you what the risk-reward relationship is. And that is very, very important on the test as well. And then finally, what we'll do at the end of our webinar here is we'll actually do some scenarios with potential clients that you might run into out there, imaginary clients, and we will do some recommendations for them based on the information that we get in the question. We'll go ahead and take a look and see what investments we have available in the question, and then we try to make our best determination of what will be best for them. Now, I will tell you that is a little bit subjective. When we recommend things for folks, a lot of times what happens is you'll have two answers that are very good, and you have to determine which of the two is going to be the better answer for you for the customer. That is kind of the tough part about test taking. But one of our webinars that we offering to you is analysis of a question and test taking techniques. So keep an eye out for that webinar. I believe it's the last one. So my good friend Mark Esposito will be doing that for you. So take a look at that one. That will give you some information about how to handle those kind of questions when you have two answers that are really good and you have to determine which of the two is the better answer of the two. So we'll do a little bit of that at the end of our webinar here today. There are basically two types of securities we can offer people in regard to investments. There are others that are like alternative type investments, but the two main types would be equity securities and debt securities. Equity securities is where a company is literally selling pieces of ownership of their company to the public. And then if you own a piece of that equity, that piece of that company, you are literally a part owner in the corporation. And you'll have certain rights depending on what type of security you're purchasing from that corporation. But it is an ownership stake that you have in this particular organization. So this would be corporations now. They would be offering equity securities where you can purchase ownership in a corporation. The other type of securities that we have that we can offer people are called debt securities. Debt securities is where you're going to be lending your money to the company. They're going to be paying interest to you on that money because it's a loan. You're loaning your money to them. And then at the end of the loan, they're going to pay money back to you to refund you your money. They actually call that refunding you money on the back end of your debt security. So we'll take a look at that. So we have equity securities and we have debt securities. With an equity security, you can lose all of your money. Every dime you have is at risk, because when the company offers an equity security, the corporation has no risk at all to offer that to you. If the company goes bankrupt, they don't owe you a dime. So you're considered an owner of the company, and owners don't necessarily get any money back if a corporation goes bankrupt. Sometimes they call that liquidation. So every dime you have is at risk if you're investing in an equity security. But if you invest in a debt security and the company goes bankrupt, they owe you money. What they owe you in the bankruptcy is the face amount of your piece of debt, which on the test is usually $1,000. So they pay you the $1,000 they owe you in a liquidation situation if you own a piece of debt. So if you own a piece of debt of a corporation, it's much safer to own that. But with an equity security, it's much riskier because you can lose everything. You can lose everything. So let's start off with talking about equity securities first, and then we'll talk about debt securities second. The most common type of equity security out there is called common stock. All corporations sell common stock of their company to people. It's the most common type of stock, so that's why we call it common stock. You can buy common stock from any corporation in America out there that you wish. Now, common stock is a growth product. In fact, it's one of the few investments that historically has consistently beaten the inflation rate. The inflation rate is, the cost of living going up over time, the cost of living. You have to beat the cost of living with your investments, because if you don't, you're not making any money. So your real rate of return on your investment is the rate of return you got on your investment minus the inflation rate. So let's say somebody made 10% this year on their investment, and the inflation rate is 2%. Got to subtract out the 2%, and they really only made 8% on that investment. So that's your real rate of return. So if somebody wants their money to grow over time, over many years, they'll need to invest in common stock, or maybe a product that has common stock in it. We'll take a look at some of those products, like a mutual fund or an ETF. You could have a growth mutual fund or a growth ETF that would have common stock in it, which would grow for you over time, just like owning individual stocks. So common stock historically has been the growth product. If someone wants their money to grow, or part of their assets to grow, they need to have some money invested in common stock. Now, what most people do with common stock is they buy it at a low price today, anticipating that the price is going to be higher in the future, so they can sell it at a higher price than what they bought it for. That's called a capital gain, making money when I sell that security. Now, there is long-term gain that people can make, and there's short-term gain that people can make. Long-term gains would be if you held the stock for longer than a year and you sold it and made a gain. That's a long-term gain. Long-term gains are taxed at a lower tax rate than short-term gains are. Short-term gains is where you purchased something and sold it within a 12-month period, 12 months or less. Now it's a short-term gain. That's just regular marginal tax rate on that. So you're just going to have a regular tax rate on short-term gains, but a lower tax rate, much lower tax rate on long-term gains. In fact, for most Americans, long-term gains are only the 15% bracket on that. So that's going to be a lower tax rate if someone's doing a long-term gain versus a short-term gain. But again, with common stock, people are looking for growth of their money, either a short-term type of growth, or probably, I would say more commonly, would be a long-term growth situation that they're looking for with common stock. So what type of stock out in the marketplace would be a growth product? Well, technology stocks certainly are. New technologies are coming into being all the time, and my understanding is one of the really hot industries to be looking at today is AI, artificial intelligence. I mean, we have a lot of artificial intelligence in pretty much everything we have in our lives now. But for the reading that I've been doing, the research I've been doing, it's going to be integrated into almost everything that we have, and everything we do in our lives is going to have artificial intelligence built into it at some particular level. So investing in stocks in the artificial intelligence technology stocks, that would definitely be a portfolio of growth type stocks, maybe even aggressive growth with some of those. Some of those could be even considered aggressive growth type investments if you're investing in technology stocks. Probably the most famous technology stock, was Apple. When Apple first came out, let's say you bought it for like, $5 a share or something like that. It actually came out at a very low price, many, many years ago when it was the company first began. So maybe you bought it $5 a share, and then today you could sell it for, I didn't look at the price lately, but $200, $300 a share you could sell it for today and make a humongous long-term capital gain on something like that. So a lot of people, refer to Apple stock as the quintessential technology stock that, dang, if I'd have bought that at $5 a share, years ago, how much money I'd have today if I sold it, and what a tremendous gain I'd be able to make on that investment. The other reason people buy common stock is for income purposes, because common stock can pay dividends to you. Dividends are declared by the board of directors of a corporation. The board of directors are the executive team of a corporation. They make all the big decisions for a corporation. One of the decisions they decide is how much of our earnings for the year do we pay out to our stockholders, the owners of the company. The earnings of a corporation really is, sometimes they call it net income. It's the income of the company that they made minus all their expenses, minus all of their taxes that they pay. What's left over is the net income, and then the board of directors will decide, how to pay that money out, what part of that to pay out to the stockholders. Now, the board of directors doesn't pay all the money out to the stockholders for their earnings each year. If they did that, the company would go broke. So they pay part of it out to you in a dividend. Now, they can pay you a cash dividend, where they literally pay you in cash, in dollars and cents. They could also do a stock dividend, where they give you extra stock instead of cash. And theoretically, they could also give you what's called a product dividend. It's pretty rare these days, but it might be a situation where they give you some of the product that they manufacture as a dividend. Years ago, that was on the Series 7 test. We haven't seen it in a while, but it's something you might see as a potential answer, because product dividends do exist. So you might see that on a test as a possible answer on a question. I don't think it'd be a question, but it might be an answer that you see on it. So let's talk about cash dividends. Cash dividends is where they're literally going to give you cash. The board of directors decide how much cash per share they're going to pay each year. Let's say it's $4 per share. Dividends are paid quarterly, every 3 months. So what you'd receive as a cash dividend is $1 every quarter, $1 every quarter. So every 3 months of the year, you'd get a dollar per share, and that'd be the income you receive. And then the next year, the board of directors would declare a new dividend. Maybe they declare a dividend of only $2 a share, maybe the next year, and now you're only going to get 50 cents every 3 months for the next year on that one. So the board of directors determines how much that dividend is going to be. Some companies want to hang on to their cash. So instead of paying out cash dividends to the stockholders, they pay stock dividends, where they give them extra stock. They declare how much it's going to be for the year, and then again, every 3 months, they pay out stock dividends to you instead of cash. That would be smaller companies that haven't been around that long. They want to hang on to their cash. They're trying to grow the company. They really don't pay cash dividends to people. They normally pay stock dividends to people instead, so the company can hang on to their cash. Also, research companies, research and development companies like drug research companies and research companies that might be doing research in cancer research or something like that. It's a tremendous amount of cash you have to spend to do research. So those type of companies probably would pay you a stock dividend also, instead of paying out a cash dividend to you. By the way, you might get a question on the that would say, who would prefer a cash dividend? What type of investor would prefer a cash dividend, and who would prefer a stock dividend? Well, if someone's looking for income right now, they need money coming into their budget right now, they would prefer a cash dividend. Now, who would that be? Well, it probably would be an older person that's in retirement right now who's trying to boost their retirement income to support their monthly expenses that they have in retirement. But it's really anybody who's looking for income right now. They would prefer a cash dividend from a company. If you have a younger person who really isn't interested in income right now and they're looking to grow their money for the future, they would probably prefer a stock dividend because they're going to get extra stock that theoretically will grow in value over the years, and they'll be able to sell that stock at a higher price in the future and make a huge capital gain over time on that stock dividends that they receive. So if someone's looking for growth of their money, they probably prefer a stock dividend. If they're looking for income right now, they would prefer a cash dividend. The other type of stock we have is preferred stock. Preferred stock is preferred over common stock. That's why they call it preferred stock. And those investors, those people that own preferred stock corporation are preferred in two ways. One way is if the company goes bankrupt, the company will pay the preferred stockholders the money they owe them first, and they pay the common stockholders last. Now, technically, the company doesn't owe the preferred stockholders anything either, because they don't owe you a dime if you own stock. But if the company has the money to do it, they will pay you off first if you're a preferred stockholder, and then they pay the common stockholders off last if they have any money left over to do that. The other reason preferred stock is preferred over common is when they pay dividends. The board of directors has to pay dividends to the preferred stockholders before they can pay any dividends to the common stockholders. So the preferred stockholders are also preferred in terms of the dividend payout that the company will pay. Now, preferred stock is not a growth product. This product does not grow for you. It's an income producer now. Somebody looking for income right now, this is a great product to talk about with folks because it's a really good income producer for them. Now, the par value is an arbitrary number that the company assigns to a particular stock. And preferred stock on the test, your test is probably going to be $100. There's $200 par, there's $500 par on the marketplace, but $100 is the most common type. So that's probably what you're going to see. What we do is we take the par value, multiply it times the stated annual dividend rate that's on your stock certificate, and you multiply that times $100 and you'll get the dollar amount that they're going to pay each year. So it's actually called a stated dividend, an annual dividend you're going to receive from that security. Let's say it's a 6% annual dividend rate. You multiply the 6% times $100 par value, and you're going to receive $6 per year on that preferred stock. Common stock does not have an annual dividend rate that's on your certificate. You really don't know what the dividend rate's going to be from one year to the next on common. But on preferred, it's a promise that they're making, to pay you income on a regular basis. So if someone's looking for income now, this is a good product to recommend with folks. Keep in mind though, preferred stock, it is a stock, so 100% of your money is at risk, just like it is with common stock. So you get a nice income from these products from preferred stock, but you also have all your money at risk. So if someone doesn't want to do that, preferred stock wouldn't be a good recommendation for them. But if they're willing to have their stock, at risk in terms of their money at risk purchasing that stock, it is a good product to talk about with folks. What is the risk you run with preferred stock besides the fact you can lose everything if the company goes bankrupt? Well, the other thing is they might not be able to pay you the dividend they're supposed to pay you. They're supposed to pay you $6, but maybe they have a bad earnings year and they can only pay you $2. So you're not going to get the $6, you only get the $2 for the year. Again, remember they pay dividends quarterly, so they're going to pay you 50 cents a quarter for the year because they can't pay you the $6 for the year. That's possible. That's possible. Now, there are some types of stock you can purchase where you're going to be able to get caught up on dividends that are missed with the preferred stock. They're called cumulative preferred. Cumulative preferred, they will go back and look at the dividends they missed in the past and catch you up first before they pay any other preferred stockholders dividends. So you have preference over the preferred stockholders if you have a cumulative preferred. So that's one of the types that people can purchase. Keep in mind, the corporations don't give you something for nothing. If they give you a cumulative preferred, the dividend rate's going to be lower than their regular non-cumulative preferred would be. Instead of 6% a year, it might be 5%. it's going to be lower with cumulative preferred because they don't give you something for nothing. And you'll see it as you go through your studies with preferred stock. There are many different kinds of preferred stock, and if you get a benefit of some kind from the corporation, it has a lower dividend rate on it than the regular non-cumulative type preferred. So that would be one of the risks you run with preferred stock. The other risk you run with preferred stock, besides the fact that they might not be able to pay dividends to you, is the fact that preferred stock, historically, the income you receive from that has not beaten the inflation rate over the years. It can beat it in some years, but it's not going to be a product that's going to beat inflation over time. So again, you would have some inflation risk there with preferred stock, at least some types of preferred stock. Some types you might not have as much, but other types of preferred you might. Another type of equity security we have out there called American Depository Receipts. This is a product people can purchase that represents a foreign stock. So let's say you want to buy a stock of a corporation that's in Spain. You could get on a plane, an airplane, fly to Madrid, Spain, find a stockbroker there in Spain who could sell you that stock in Madrid, and you'd be able to purchase that stock over in Spain. But how much money would that cost you to fly over to Madrid, Spain, and stay in a hotel and all the expenses you'd have to incur in order to do that? Cost you a fortune, right? Wouldn't it be easier to purchase something that looked like the foreign stock and acted like the foreign stock but wasn't the foreign stock? You could do it right here in the United States and purchase it very, very easily. They're very liquid, they're very easy to purchase, and give people the foreign exposure that they're looking for. One of the things we're not very good at in our industry is recommending foreign securities to people. Even a conservative investor should have a little bit of their assets overseas, maybe like 5% or so, maybe less, a small percentage, because if they do that, they will potentially increase the rate of return of their portfolio of investments. So American Depository Receipts are a great way to do this. Now, they call them ADRs for short. You do need a Series 7 license to sell these securities. I will show you there's other securities you can sell without a Series 7 that will also give people international exposure for their investments. So this is one of the things you can do if you have a Series 7 license. It's a great diversification tool. If someone's looking for a little bit of international exposure. Now, if you do own an ADR, you'll be purchasing that through an American bank that has an office over there in Spain, and they're selling you something that looks like the stock and acts like the stock, and you're also entitled to the dividend of that foreign company. So the dividend is actually paid out to the bank because the American bank actually owns the stock, and then they will take that dividend and they'll pass that on to you. So we could have an American Depository Receipt that could give you an income as well, because there are certainly international stocks that do pay nice dividends. So you would be able to get that. However, what happens with foreign securities is if you get income from that, it is normally paid out in the currency of that company, that country. So the Spanish currency is what the dividend would be paid out to the American bank, and then the American bank would have to exchange that for US dollars and then give you the US dollars. You could lose money on that exchange when they do that. It's called foreign currency exchange risk. So that's one of the types of risks that you do have with American Depository Receipts. Investment risk is the fact that your investment could go down. The rate of return you have in an ADR is the same as if you purchased a security, actually a physical foreign stock itself. If the foreign stock goes up by 10%, your ADR goes up by 10%. If the foreign security goes down by 10%, your ADR goes down by 10%. That's investment risk. But then we also have foreign currency risk. If the company pays dividends out, they pay them to the bank in the Spanish currency. They probably do that in euros. Euros are the currency they use over there in Europe. Most of the major countries out there use the euro for this type of payout. So maybe they pay them out in euros, and then the bank, your American bank, has to exchange the euros for American dollars and then pay them to you. That's the foreign currency risk that you'd have. So you really have two kinds of risk here with ADRs. You have investment risk and you have the foreign currency risk. These are very good diversification tools if someone's looking for a little bit of foreign exposure with their investments. They're very liquid. They trade on exchanges. They trade in the over-the-counter market. Very easy to buy and sell ADRs out there. Now, the other type of security that people can invest in are debt securities. Debt securities is where you're lending your money to the corporation. They're borrowing money from you. And if they're borrowing money from you, they have to pay interest on that money to you on a regular basis. And then at some point, they're going to have to pay money back to you on the back end of that piece of debt. We have notes and we have bonds. Notes are between 2 and 10 years of maturity. So you're going to get your refunded money within 2 to 10 years. You could have like a 3-year note, a 4-year note, a 7-year note, a 10-year note. And then we have bonds. Bonds are longer than 10 years, like a 15-year bond where you're going to get refunded money 15 years from now, or a 20-year bond, you're going to be refunded money 20 years from now. So bonds are longer than 10 years. Notes are between 2 to 10 years for corporations. On the test, they usually focus on bonds. So we're going to focus on bonds here for this particular webinar because the FINRA tests, they do focus on bonds instead of notes. But just so you know what a note is, it's kind of like a bond that it's just a shorter maturity, really is what it is. Now, bonds and notes pay interest every 6 months. At least most of them do. So they'll have an annual interest rate that is on your bond certificate. You divide that by 2, and that's how much they're going to pay you every 6 months on that particular investment. Now, the par value of a bond is not going to be $100 like it is with preferred stock. It's going to be $1,000 on the test. You got to add a zero. Add a zero to that. Then you take the $1,000, the par value, multiply times the annual interest rate, not the annual dividend rate, the annual interest rate that's on your certificate, and then you'll get the amount of money they're going to pay you each year. Let's say you have a stated annual interest rate of 8%. 8% times $1,000 is $80 a year. Now, most companies pay interest every 6 months to you. So if you divide that by 2, it's $40 every 6 months that you receive, like clockwork from that particular investment. These are excellent income producers for people. Excellent income producers. And then on the final day of the bond, the maturity date of the bond, they're going to pay you the $1,000 plus your last sum of annual interest payment, which in this case would be the $40. So they'll pay you $1,040 on the last day of the bond. Good income producer, someone looking for income right now. And debt securities are safer than equity securities because if the company goes bankrupt, they owe you the par value of whatever the par value is of your particular debt security. So this is much safer for folks too. So if someone's looking for safety, this is going to be a good investment for them as well. In most cases, it's going to be a good safety type feature. So here's our investor. He's giving money to the issuer. The issuer is the corporation that created the bond, that's borrowing money from the public, and the investor is saying, I hope I get my money back. Now, we do have the rating services that measure default risk. Default risk is one of the risks you have with the debt security. It's the risk that they can't pay you an interest payment or they can't pay you the principal on the back end of your bond. Either one of those is called default risk. So we have the rating service for that. We have Moody's, we have Standard & Poor's. You might see the Fitch rating service on the test. Standard & Poor's and Fitch uses capital letters for their rating system, and Moody's uses capital letters and small case letters. A's are excellent. Shouldn't really have too much default risk there if they have an A rating of some kind. B's are usually okay. Some are good, some are not so good. C's are not good, and D's are really bad. And there is no F. If a company gets an F, they flunk, and that's a company that essentially is bankrupt. So we use the rating services to be able to look up bonds to get a rating for that bond so we can get an idea of what the default risk is that you'd have with a debt security. So we can do that. The other type of risk you have with debt securities is interest rate risk. If you remember from your reading, your studying on some of these tests, you know that if interest rates go up, the value of your debt security goes down. It's inverse of interest rate. So that's another risk that you run. And the longer the duration on your security, your debt security, duration is a time value money calculation that determines how many years it's going to take to get your original investment back in today's dollars. If that's a long duration, you're going to have a very high sensitivity to interest rates. But if the duration is short, only a few years, then you're going to have much less sensitivity to interest rates when interest rates move out there. So that's the other thing. The other risk you run with debt securities is you have interest rate risk. Another type of risk you have is inflation risk. Depending on the safety of your particular default risk you have on this bond, you could have a bond that's super, super safe, but the interest rate you're receiving on it's going to be low on that type of security because it is so safe, low risk, low reward. And don't forget, your real rate of return is a rate of return on your investment minus the inflation rate. So you have to subtract that out. Let's say somebody has a 2% bond that they have. You subtract that inflation rate of 2%, that person's making 0% on that debt security. So we got to make sure people are aware of that. The debt securities historically have not beaten the inflation rate. Really, the only security that's done that consistently is common stock. So this particular investment will not be beating the inflation rate over time. So you have to make sure people are aware of that inflation risk. Sometimes they call that purchasing power risk. Purchasing power risk. Now, corporations can certainly offer bonds to people. You can purchase bonds of corporations. They have different types of bonds out there. Basically, two types. We have secured bonds and unsecured bonds. With a secured bond, they have collateral backing it up. So you can feel pretty good if you purchase a bond of a corporation, secured bond. They've got collateral backing it up. So it's some sort of asset the company owns. What they'll do if they go bankrupt, they'll sell the asset and they'll just use that money to pay you off as a secured bond holder. One of those types of bonds you'll see in the test is called a mortgage bond. And with a mortgage bond, they have some sort of real estate that they own, like maybe it's a building they own or a piece of land that they own, something like that. And they have a mortgage on it, obviously. So essentially what they're doing is they're using the bond as the mortgage for this particular particular piece of land or a corporation, maybe a building that they own. So they'll finance that building using these bonds, and then they pay interest on the bonds every 6 months, and then when the bonds come due, they go ahead and pay them off to the bondholders. If the company would go bankrupt, they simply sell the building and they use it to pay the bondholders off. By the way, secured bondholders are the first bonds that are paid off in a bankruptcy, so they would have the lowest risk for you, but they'd also have the lowest rate of return because they have the lowest interest rates on them. Less risk, less reward for people. So this is going to be a low risk, low rate of return. Rate of return is called yield on the test. Sometimes we call them low yield, low risk type investments. These are your secured bonds. Another type of secured bond you might see on the test is the collateral trust bond. This is where the corporation is using securities that they own. You know, companies buy stocks and bonds just like you and I do. So they might have some securities they own and they're using that as collateral for this bond issue when they're borrowing money from the public. Let's say that IBM owns stock in Coca-Cola. They could use their Coca-Cola stock as collateral for a collateral trust bond. So that's an example of a bond that could be out there in the marketplace. Theoretically, they could use any type of security as collateral for a collateral trust bond. Then we have what are called equipment trust certificates. These are also bonds that are offered by oil companies and transportation companies. They're using their equipment as collateral for the bond issue. So if it's an airline, they'd be using their airplanes as collateral for this bond issue. If it's a company like Greyhound Bus, they could use their buses that they own as collateral for an equipment trust certificate. And then we also have oil companies like, you've got British Petroleum. They have drilling equipment that they use to drill for oil, and they have the oil derricks on land, and they have the oil rigs, above water. All of that is equipment that they own. They could use that as collateral for an equipment trust certificate. So just think of it as a bond that has collateral that's where the company's using equipment that they own. And on the test, again, that's going to be oil companies, and that's going to be transportation companies. Then we have the unsecured bonds of a corporation. They are actually underneath secured bonds in the pecking order when a company goes bankrupt. They have to pay the secured bondholders off first using the collateral that's backing those bonds up, and then they pay the unsecured bonds second. Unsecured bonds have no collateral backing them up. They're only backed by the full faith and credit of that corporation. I call it a warm smile and a handshake. That's all it is. So that's going to be a little bit riskier for the investor to invest in an unsecured bond because they're going to be paid off after the secured bondholders are paid off in a bankruptcy. Well, if they got a little bit more risk there, wouldn't they have a little higher interest rate on those bonds that the company would offer? Yeah, they have to do that because they got to compensate you for the extra risk that you're taking. So maybe the secured bond that they have that they're offering you might be like, a 6% bond, let's say, and an unsecured bond might be offering 6.2%. A little bit higher interest rate, which is going to give you a higher yield, a higher rate of return, because you're willing to take a little bit more risk with an unsecured bond. Sometimes they call unsecured bonds debentures on the test. I would say that those words are interchangeable. If you see the word debentures or you see unsecured bond, they mean exactly the same thing. It's a bond that has no collateral backing it up, going to be a little bit riskier than a secured bond would be. Then they also have what are called subordinated debentures. That's the last piece of debt a company pays off in a bankruptcy. Last piece of debt. They are also debentures. They don't have any collateral backing them up, but in a liquidation, in a bankruptcy, they would be paid off after the debentures. So that is the last piece of debt the company would pay off if they have subordinated debentures. They subordinate them underneath the other debentures they have out in the marketplace. So wouldn't you be taking a little bit more risk with a subordinated debenture than a debenture? Yeah, you are. So the subordinated debenture might be paying 6.4%. A debenture could be 6.2%, and the secured bond of the company might be paying 6%. So you can see you're going to get more reward if you're willing to take a little bit more risk with these different types of bonds that are available through corporations. There's a lot of different kinds of bonds out there. We have convertible bonds that allow you to convert from the bond into the common stock, which it was kind of an interesting product because you get a nice income from it because you're getting that interest every 6 months, but you also benefit if the common stock price goes up. If the common stock price goes up in the marketplace, it does bring up your bond price. Your bond price will increase in value, and you can always convert into the common stock if you wish. They have a fixed price you're going to receive it at when you convert. And if the price of the stock is higher in the marketplace, you could sell the stock at a higher price than what you converted at and make money on that conversion. They call that convertible arbitrage, making money with convertible products. So that's an interesting product, kind of the best of both worlds. Gives you the safety and income of a bond, but also gives you the appreciation potential of owning the common stock in that corporation. Then we have what are called guaranteed bonds. Guaranteed bonds aren't really guaranteed. You got to be careful if you use the G word with people. It's not a very good word to use with customers because it just really gets their hopes up. Here's what it means. It means that a higher entity is guaranteeing the interest and principal payment of a lower entity of some kind. It's normally a parent company that's guaranteeing the interest payments and the principal payment on the back end of a bond or a note of one of their subsidiary companies. So think of it like a parent corporation that is guaranteeing the interest payments of subsidiary corporation. Essentially, it works like this. If the subsidiary corporation does default on the loan, it goes to the parent company, and they're going to have to pay the interest or principal, and they're responsible for it. So essentially, they're responsible for any default of a subsidiary company if it's a guaranteed bond. Then we have what are called income bonds. Yeah, income bonds really don't give you a very good income. They're kind of an oxymoron. They only pay interest to you if the company has net income for the year. Remember, we said net income is the income of a company after they pay their expenses and their taxes. Well, if they don't have any money left over, they aren't going to be paying any interest on an income bond. Another name for those are adjustment bonds. Those are the first bonds that come out in the marketplace if a company has gone into bankruptcy and now they're coming out of bankruptcy. The first bonds you'll see they'll sell in the marketplace are called income bonds. They only pay interest to you if they have net income for the year to pay for it. Well, corporations are not the only organizations that borrow money from the public. United States government borrows money from the public. They've been borrowing a lot of money from the public over the years. I didn't look up what our national debt is recently, but the last I looked, it was around $23 trillion, and it just keeps going up and going up. So the debt of the United States government is called direct debt. That is the debt of the government where they owe people money that is unique to the federal government, direct debt. And there's 3 different types of direct debt out there that people can purchase. One type is called Treasury bills. Treasury is the Department of Treasury, the United States Department of Treasury. Sometimes we call them T-bills for short. So if you ever see a T, that's the United States Treasury Department. Treasury bills, I think in most people's minds, are probably the safest investment you can put your money in. They are very, very short-term investments. They are fully backed by the printing power and taxing power of the United States government. So the default risk on a treasury bill, or really any treasury of the United States government, is virtually nil. You're not supposed to say there is no default risk, but the chance of the federal government defaulting on a treasury bill is incredibly remote, because they have printing power, they can print money whenever they wish, and they can raise our taxes whenever they wish. So a lot of people would say treasury bills are one of the safest places you can put your money if someone wants to park it there. Now, these are 1 year or less maturities. They sell them in weeks. You have a 4-week T-bill you can purchase. There's a 13-week T-bill. There's a 26-week, and there's also a 52-week. So they're 1 year or less, very short maturities. And you buy them like a zero coupon bond. A zero coupon bond is where you purchase it at a discount underneath your par value. It doesn't pay any interest to you on a regular basis. That's called periodic interest. It doesn't pay interest. You just get the principal back on the back end on the maturity date. So it's the same way with a T-bill. Let's say you have a $1,000 maturity value for your T-bill here. You buy it at $999.70. And in 4 weeks, you get $1,000 back and you make 30 cents. That's a treasury bill. Really short-term, super safe investment for someone who's looking for that type of safety of their money. Now, treasury bills have inflation risk. They are not going to beat the inflation rate. In fact, they get clobbered by the inflation rate. So this is not a long-term investment. Remember, they're 1 year or less. It's not something that somebody's been investing like for retirement or college funding or something like that, because they will be nowhere near the inflation rate. They're not a long-term investment. They are short-term only. The other type of risk you'd have with treasury bills is interest rate risk, but it's really, really low because the duration on treasury bills is in weeks. So there's hardly any interest rate risk. I mean, a little bit, but hardly any if you had a treasury bill. So hardly any interest rate risk, but you do have inflation risk here with treasury bills. Then we have treasury notes. That's called intermediate debt of the federal government. They're similar to corporate notes where you purchase this, it pays interest every 6 months to you like clockwork, and then pays you the principal amount on your final day of your note, plus your last semi-annual interest payment. Very similar to a corporate note or a corporate bond, but it's debt of the federal government instead of the debt of a corporation. They're offered in maturities of 2 to 10 years. Again, super safe investment, virtually no default risk because the federal government can raise taxes or print money anytime they wish to pay off a treasury note that someone might have. So very, very low default risk here as well. A little bit higher rate of return for you though than you'd have in a treasury bill. Not a lot higher, but a little bit higher in terms of what you'd get. Again, you'd have inflation risk there. You subtract out the inflation rate on treasury notes and you're not going to beat that inflation rate. So that's another risk you have with treasury notes, is you're going to have inflation risk. Then we have treasury bonds. Again, bonds are longer than 10 years. So this is debt of the government where you're lending your money to them for a longer period of time, like a 15-year bond, a 20-year bond. Again, it would pay interest every 6 months to you like clockwork. Because these are longer, they're going to have more interest rate risk for you. More duration, you're gonna have a little more interest rate risk here, which means the interest rates on these are gonna be a little bit higher than a treasury note, more risk, more reward. But again, historically, treasury bond interest rates have not consistently beaten the inflation rate, so you would have inflation risk here as well. One other thing I'll make a comment on with US government debt is how it's taxed when you receive the interest from these vehicles. It's taxed at the federal level only. So you only put the interest on your 1040 form when you file your federal taxes. It is not taxed at the state and local level. So if someone's in a high tax state and they're in a state where they charge taxes at the local level on interest at high rates, someone might take a look at this as a possible investment for them, because they don't have to worry about the tax at the state level and they don't have to worry about tax at the local level for treasuries. Then we have municipalities. Municipalities is any government that's smaller than the federal government. So we've got the federal government. What government would be smaller than that? Well, underneath the federal government, we have state governments. I live in the state of Wisconsin. So Wisconsin So the state of Wisconsin would be the a municipality. And inside states, we have cities and counties, and we have counties inside states. So I live in Milwaukee County. So Milwaukee County would also be a municipality. Then inside counties, we have cities and townships and villages. They would also be considered municipalities. I live in the city of Milwaukee. So the city of Milwaukee is a municipality. Well, municipalities borrow money from people too, and they have a lot of debt. I didn't look it up lately, but the last I saw is about $5 trillion of debt that our municipalities have. Not as much as the federal government, but it is a lot. So they borrow a lot of money from the public as well. There are basically two types of municipal securities out there, municipal debt. We have general obligation bonds, and we have what are called revenue bonds. Again, bonds are longer than 10 years, so they pay interest every 6 months to you like clockwork. They're great income producers. A little bit safer than a corporate bond because municipalities have taxing power, but not quite as safe as a US government bond because municipalities don't have printing power. They can't print money to pay off their debt. So it'd be in between a corporate bond and a US government bond. A municipal bond would be in between in terms of risk and reward for you. General obligation bonds are the type of bonds that municipalities would offer to people where they're borrowing money to do things in your community that everybody can benefit from. They're backed by the full faith and credit and taxing power of that particular municipality, so they're very safe. And we do need voter approval in order for us to do a general obligation bond and offer that to the public, because the way they work is this. They're borrowing this money from the public, and they're going to use the tax money of the citizens of that community to pay the interest every 6 months and pay the bonds off on the due date many years down the road. So they got to get voter approval for most general obligation bonds in most states in order for them to do a municipality to create a general obligation bond and offer that to the public. The other type of municipal bond we have out there are revenue bonds. Revenue bonds are actually backed by the user fees of a facility that the municipality is building. A good example of that might be a tollway. You know, down in Illinois, they have tollways down there. So if they refurbish a tollway, they use the toll money to pay the interest every 6 months on the revenue bonds that they created to pay for the renovation of their tollway. And on the maturity date of the bonds, they use the toll money to pay off the principal to those bondholders. So that's revenue bonds. They're backed by user fees. So they're not backed by the taxes of a municipality. They're backed by user fees. So these would be a little bit riskier for an investor than a GO bond would be. Not a whole lot. Maybe they're paying 4% on their general obligation bonds. They might pay, 4.1%, 4.2% maybe on a revenue bond, because it does have a little bit more risk, the investor, more risk, a little bit more reward for you. So yeah, they could use revenue bonds to build a bridge that would have a toll. So they use the tolls, the people are paying for the bridge. They use the toll money to pay the interest every 6 months to the bondholders, and then they pay the bonds off using that same toll money. Of course, tollways, we talked about that, toll roads, they use that money to build tollways and to renovate tollways, and then they pay the bonds off on the maturity date using the toll money from those toll the toll booths. Also, stadiums oftentimes are financed by revenue bonds, where they'll issue revenue bonds to build the stadium, and then they normally use the concessions for the income to pay the interest every 6 months and pay the bonds off when they come due. So if you wonder why your beer and your nachos and your hot dogs are so expensive at stadiums, it's because they increase the prices on those concessions in order to cover the costs of the interest payments every 6 months of the bondholders and pay the bonds off when they come due. Now, the beauty of munis, the beauty of municipality securities, is the interest you receive from these as an investor is not taxed at the federal level, and it probably isn't taxed at the state and local level either. So a lot of times we have a very low tax rate or no tax on the interest you receive from municipal security. That's a big deal for someone who's in a high tax bracket. You got a customer that has a really high income, annual income, and they're in a really high tax bracket. They're looking for income from their investments now. Municipal securities are a good answer for that, because they'll get income from it that is going to be very little tax, maybe zero tax, that they'll have to pay on the interest they receive on a municipal security of some kind. So these are really good for people looking for income now that are in a high tax bracket and they want to have a tax advantage with the income they're receiving from that investment. Another investment they're going to ask you about on the test is investment companies. One of the investment companies you're going to see on the test are mutual funds. I think they have them on the test because they're probably the most prevalent type of investment company out there. Investment companies, what they do is they pool people's money together, and then they manage it for you in a professional way according to an investment objective. And then what you do is you match up the client's investment objective with the mutual fund's investment objective, and you sell it to them so that it gives them the type of performance or the type of income, whatever they're looking for, based on their particular investment objective. So what are the advantages of mutual funds? Well, again, you'd have the professional management. You know, they probably have an investment advisory firm that's managing your assets here in this mutual fund. It's a company where they've forgotten more about investing than you and I will ever know. So they have tremendous computer technology and tremendous research abilities to be able to pick stocks and bonds and purchase them at the right time and sell them at the right time, where you and I really wouldn't have that type of ability. So professional management, huge advantage of working with a mutual fund. Another one is mutual funds could very well be a situation where the overall costs you pay for this fund could be less than buying the individual stocks or bonds yourself. We do have fees people have to pay, percentage fees they have to pay when they're buying and selling securities out there in the marketplace. A mutual fund might make it more cost efficient for them. So that's another feature of mutual funds that you would see on the test. Diversification, wonderful advantage of mutual funds. They're very diversified, spreading you out over many investments in many different kinds of industries and investment categories. We have an incredible number of mutual funds out there that can give people the diversification that they're looking for, making sure that they're not locking their money up in one company or one particular type of asset. We can spread them out into many different kinds of investments using mutual funds. And low minimum investment. You know, most mutual funds have a $500 minimum to get in, and then they'll let you do $25 a month out of your checking account if you want to for investment purposes. So anybody in America can invest in mutual funds. You know, years ago when people were buying and selling stocks, it was 100 shares at a time is what you had to buy. In fact, that's the way it is today. 100 shares is the minimum investment out there if you're buying and selling single stocks. But with mutual funds, you don't have to do that. You can give money to a mutual fund and they'll buy what are called fractional shares of the mutual fund for you. You might be giving them some money and they'll buy 41.666667 shares. So you don't have to buy them in round lots of 100 shares at a time. So low minimum investments for people to get in. Anybody can get in. and very flexible. Mutual funds have to give you your money if you want to sell your shares within 7 business days. They usually do it in 3. So they're very liquid. If someone wants to sell their shares and get money, they're very flexible. And we have a lot of companies that have a family of mutual funds where you can move your money around inside the family of funds and only pay a sales fee once. When you come to the company once, you can move it around inside the family of funds and you'll never pay another sales fee again as long as you stay in that family of funds. So many, many choices, very flexible, and people get involved with mutual funds. Another type of investment company you might see in the test are called ETFs. You need a Series 7 in order to sell these products, but these are products that are considered on an open-ended investment company. That's another name for a mutual fund, but they don't trade the same as mutual funds. With mutual funds, you buy your shares from the mutual fund, and then if you want to sell your shares, you go back to the mutual fund, and they will sell them to you. So you buy them from them, and then if you want to sell them, you sell them back to the mutual fund. Another thing with mutual funds is they have what's called forward pricing. The price of your shares, if you're buying or selling today, is in the future. They calculate at the end of the day, and they use that price for your buy or sell price. It's called forward pricing or future pricing. ETFs are traded on exchanges like a stock, so the price is changing throughout the day. You can look it up on your phone anytime you want to for an ETF. So it does trade in an exchange. It's called intraday pricing, and you buy it and sell it in round lots, very similar to buying a stock out there. Round lots are 100 shares at a time, so you can buy them in round lots out there for ETFs. You do have to pay a commission when you buy shares. You pay a commission when you sell shares. So you got to be a little careful with ETFs. You don't want to have people buying and selling, because to do that, they will burn up their rate of return with commissions. You really want to do more of a long-term approach if somebody's using an ETF for their purposes, because if they buy and sell them too much, it does eat away into their rate of return. Another advantage of ETFs is you're only taxed if you sell the shares for more than what you paid for them. With a mutual fund, they send you a dividend at the end of the year, and they also send you a capital gain distribution. You have to pay tax on both of those things, whether you want to or not. With ETFs, they don't do it that way. You only have to pay taxes if you sell it for more than you pay for it. So ETFs would have a tax advantage over mutual funds as well. This is a grid that kind of gives you an idea of the type of funds you would recommend to people, the type of funds you'd recommend, either a mutual fund or an ETF fund, based on what their risk tolerance is and how much risk they're willing to take and how long they have to invest. So if there's someone who has a really high risk taker and they only have a few years to invest, you might want to take a look in like 1 to 3, maybe 4 to 7 years. You might want to talk about sector funds with them. That's where they're investing in a sector, an industry sector or a regional sector where they could have a growth situation in that short amount of time. Maybe the industry, the financial sector has been down and it's going to really come back strongly. Maybe they want to invest in a sector fund of financial stocks, financial type investments in there. They would do well in a sector fund. That's a pretty risky fund though, because sector funds can get clobbered, but they can also do really well out there in the marketplace. If somebody has a little more time to invest, over 7 years, we probably would recommend like a mid-cap equity fund or a small-cap equity fund. Mid-cap means medium-sized company. Capitalization is how big you are. It's your share price times the number of shares you got. So the really big companies are called large-cap companies, large-cap corporations. Mid-cap are the mid-sized companies, and the small-cap are the smaller ones. Small-cap companies, they make a lot of money, but there's tremendous default risk there, tremendous investment risk there, because a lot of those little companies go bankrupt. The mid-sized companies is not as much risk, but not as much reward for you in terms of investment over time. So the mid-cap would be kind of medium risk, and then the small cap would be much higher risk if someone's willing to take that. If someone has a high risk profile and they have a few years to invest, might want to look at some sort of balanced situation where they have some money maybe in stock, a little bit maybe, and then most of it in some sort of debt security. The shorter the time frame they have, the more you have in debt securities because it's safe. So if they only have a couple of years, you'd have a lot of it in bonds, let's say, and just a little bit in the stock market. If they have a little more time to invest, you'd have a little bit more balance in terms of equities in a situation like that. If someone's going to invest over 7 years with a high risk profile, large cap funds are a good way to go for people. Again, those are the large companies. You can buy equity funds, either mutual funds or ETFs that are like that, and give people that more of a long-term approach and make money over a longer period of time. If they have a medium risk profile, maybe you talk about medium or long-term type debt funds. That would be funds that have medium, would be intermediate debt like notes, or maybe bonds that would be longer term debt. That wouldn't be a bad choice. Probably do the same type of thing if you were looking at a longer time frame to invest in. Probably would do a little bit more in something to give them a little more growth. And if they've got 4 to 7 years and they want a medium risk level, well, then you probably do a hybrid where you'd have part in stocks, part in bonds, but again, a little bit more in bonds than you'd have in stock if you're looking at kind of a shorter time range on that. A lot of it depends on how long they have to invest. And then we have people who want low risk, really like no risk at all, those types of people. Well, then you're talking about money market mutual funds, or maybe short-term bond funds that are super safe, where they don't have to worry about their money disappearing on them. So those are the type of investments we could recommend for those folks. If someone has a little bit more time range where they want to invest a little bit more, maybe you'd have a little bit less in money market instruments, maybe go a little bit more into the short-term debt instruments for them. So we could do that, give them a little bit more rate of return because they have a little more time to invest. So when we are looking at funds, investment companies, mutual funds, ETFs, we certainly have to look at the investment objective of the client. Whatever they want to do with this money, we have to match that with the investment objective of the fund itself. So maybe their objective is maximum capital appreciation. Okay, well, we need to show them a mutual fund that has a maximum capital appreciation as an investment objective. You get a prospectus with a mutual fund, and on the first line of the first page, it tells you what the investment objective is. This is how we're managing your money in this particular fund. We're managing it for maximum capital appreciation over time. You would match that up. If someone's looking for safety, you wouldn't put them in an investment objective that is maximum capital appreciation. You'd match it up with the fund itself. Another key feature when you're recommending things is the time horizon. How long do they have to invest? The longer the time they have to invest, the more aggressive we can be with our recommendations. And the client needs to be a little bit more aggressive. They have more time. If they only have a couple of years, you're really limited in terms of what you can recommend. But if they have like over 10 years to invest, well, now it opens up a huge range of investments you can offer folks for a longer time horizon. The other thing we look at is the style of the manager of the fund. Some managers are what they call growth managers, where they're looking for a long-term growth of the investments that they have in there inside your fund. Then we have what are called value funds, where they're looking for short-term gains. They buy a stock, let's say, that they think is going to increase in value in the next couple of months or so. They'll go ahead and buy it now, and the manager will sell it a couple of months down the road and make a little short-term gain for you. So value funds are looking for short-term gains, maybe like 6 months to 18-month type gains on a value fund. Growth fund is looking for long-term gains, looking for gains over a longer period of time. Then we have what are called blend core funds, where they do a little bit of both. The manager will be looking for long-term gains of investments in there, but they're also looking for short-term gains where they can buy something today and sell it for a higher price, in the next couple of months or the next year or so. That's a blend core manager, doing growth and value for you at the same time. Another key thing that I always looked at when I work with customers is, what is their investment experience now? What do they have now? If you have them take all their investments and put them on their table when you come over to their house, let's say, or their place of business, you'll get a good idea of what type of investor they are, and then it'll help you determine what you can recommend to them going forward with their investments. Are they in a 401k? Do they have IRAs? Have they invested in individual stocks or individual bonds before? Are they familiar with mutual funds or ETFs? We also have annuities. Annuities are retirement plans offered by insurance companies. So, and then we have, real estate people can purchase. We have commodities people can purchase, where they're purchasing barrels of oil and bushels of wheat. A lot of different investments. Well, if you've got people that have never invested in anything except a CD in their entire life, you really can't invest in things that they'd be uncomfortable with. You know, FINRA doesn't really have a rule for comfortableness, but I will tell you that is very important when you're working with customers. Make sure they're comfortable with the recommendation you're making based on the investment experience that they have so far. So that is a huge element that we look at. So what's the right choice for somebody? Well, if they're looking for growth, we said it's going to have something that has common stock in it, probably a common stock, a portfolio of common stocks, or maybe a funded stock, common stock, like a growth mutual fund or a growth ETF. If they're looking for income now, preferred stock or an income fund that would have preferred stock in it, that's a good choice. If they want to take a little bit less risk, maybe they look at debt securities like bond funds or individual bonds that they can purchase. That'll give them a nice income, but it'll be a little bit safer. And I would say most folks are going to be balanced in some way. Everybody should be balanced. Now, there's different balances for different people depending on what the risk tolerance is, but generally it goes like this. A starting point anyway, a good starting point. Whatever age they are, that's the percentage they should have in debt securities. So the older you get, the more higher percentage you should have in debt securities and less in equity securities, which is common stock. So I have 28-year-old twin daughters. They should have 28% of their money in bonds and 72% in stocks. Now that's just a starting point. You know, it depends on someone's risk tolerance, but that's kind of a generalization of where they should be in terms of the balance between debt securities and equity securities. I'm 59 years old this year. So someone like me, 59% in bonds, 41% in stocks. Again, that's just a starting point depending on the risk tolerance. I'm actually considered to be an aggressive investor, so I would be more in stocks for me. But that's a starting point you can use to balance somebody and then just go from there based on their own personal risk tolerance. Specialized funds is where someone's looking for, it's a high risk investment. It's where they're going to be investing in industry sectors or they're investing in sectors of our country. Sometimes they call them sector funds, those specialized type funds. They can make you a lot of money, but they can also lose a lot of money. So that's going to be a very aggressive type approach if someone's looking for that. If someone wants no risk at all, well, then we talk about money market investments. Money market investments are going to investing in things that maintain $1 per share in that fund. So if you put $1,000 in the money market and you take $1,000 out, it's the same $1,000 you put in there. So they're super, super safe. If someone's looking for safety of their money, only going to invest, you know, for a couple of months, something like that, less than a year, let's say, money market is a good choice for those people. So now what we're going to do is we're going to do some scenarios here where we'll have a scenario of a customer, and then we're going to take a look at some different investments, and we're going to make a decision on what we think is the best choice. Now, on the test, you'll get 4 choices, so we're going to have 4 different choices here. This is very subjective. You know, some people might pick one type of answer. Some people might have a very good reason to pick other types of answers, but we're going to kind of do this generally so you can kind of get an idea of what it's like to do some of these questions on securities tests. So Charles and Mary are married. They're a married couple in their 50s. They earn a combined income of $210,000. Charles would like to retire in 7 years. Mary would like to retire in 5. So that gives you the idea what their time horizon is. It's not very long. It's not very long. The couple has very low risk tolerance. That means they don't want to have a lot of risk with their investments. They want it to stay very stable from one year to the next. They're not interested in investing in the stock market at all, at all. So we need to look for choices here where we wouldn't have any of their money invested in the stock market. Now, our first answer says treasury bonds. That's not the stock market. Corporate bonds. That's not the stock market. But blue chip stocks, that's another name for large cap stocks. They're really large corporations. Yeah, that's the stock market, so you wouldn't recommend that. The second one says treasury notes, municipal bonds, and Ginnie Mae. Ginnie Mae is the Government National Mortgage Association. It's a government security where people are investing in mortgages of folks out there in America that have guaranteed mortgages through the federal government. That's not the stock market. It's actually mortgages that mortgage payments are passing along to you. It's a good income producer. So that would be also an investment that's not stock. So those three are not stock market at all. The third one says corporate bond, preferred stock, and blue chip stock. Well, of course, that's got stock in it. And the last one says treasury bills, preferred stock, and real estate investment trust. That's where you're investing in the properties, commercial properties that produce income for you out there. They're not the stock market, but preferred stock definitely is. So if somebody wants to invest with no stock at all, we'd have to pick the second one here, because we know the second one has no stock in it whatsoever. Scenario 2 is Mr. and Dr. Big Bucks reviewed their investment portfolio. They found they consisted of 50% in equities, 15% in debt, 10% in options, 25% in high yield bonds. That's the low rated bonds that have a lot of default risk. So which of the following terms would describe this person's investment style? It's really more like their how they want their money invested. They certainly wouldn't be conservative. This is not a conservative investor. They are balanced. They have, equities, they have stocks, and they have debt securities, they have bonds, they have options. It might be balanced. That wouldn't be a bad answer. Aggressive is someone who's investing in the stock market can be considered aggressive, and so can be high yield bonds. They can definitely be considered aggressive as well. So if you take the equities they have, the 50% in equities, and add it to the high yield bonds, that's 75% of their money invested in pretty aggressive things there. And then the last one is moderate. Well, if they're a moderate investor, they wouldn't have 75% in scary type investments that have a lot of risk. So moderate would not be the answer. I think we'd have to go with aggressive on this one. Again, balance wouldn't be a bad answer, but because they are investing 75% of their investments in pretty risky investments here, I think we're going to go with aggressive on that one. A lot of times what happens on a test is you'll have two answers that are pretty good, and you got to pick the one that's the better of the two. So that would be that'd be our rationale for picking this one. John and Jenny are a married couple in their late 20s with a brand new baby girl. They're both medical doctors and want to send their daughter to the best medical college they can if she pursues that as a career path. It's kind of hard to say what a baby girl is going to do for their career, but these are doctors. Doctors, would like to see their child be a doctor. They're experienced investors with a broad portfolio of investments. They're not concerned with the volatility of their accounts. That's the risk of it bouncing around all over the place. They have a long time horizon. They have a baby, so you're talking 18 years before they go to college. What should we recommend? A bank CD? Well, definitely not. How about a diversified portfolio of aggressive growth stocks? That looks pretty good, because if you're going to go to a medical college school, my goodness, that's going to be hundreds and hundreds of thousands of dollars today. And if you add the inflation rate of college tuition to that, it could be an incredibly high $100,000. So aggressive growth wouldn't be a bad choice here. What about a 10-year treasury note? Well, no, that's an income producer, and that's got safety, and it's going to be nowhere near the rate of return that they would need for a college fund, for their child. How about a balanced mutual fund? Well, maybe if the balance was very heavily balanced towards stocks and maybe a little bit in bonds, that wouldn't be a bad choice. But boy, if they're looking for long-term growth over a long period of time, and they really don't care about the fact that the investments are going to bounce around over time, they probably need to go ahead and go for the gold here, and we'll create a diversified portfolio of aggressive growth stocks for them. Dick and Jane are in their 50s, concentrating on their savings on retirement planning. Their goal is to retire in 12 years. Dick and Jane have a moderate risk tolerance and a combined income of $100,000 per year. What asset allocation would you recommend for their retirement planning at this time? Again, this is very subjective, but we're trying to pick the best answer here. And what we're going to do is we're just going to balance them between stocks and bonds. What percentage should be in the stock market? What percentage should be in the bond market here for them? 80-20, well, again, if you do as a starting point of their age being the percentage that should be in bonds, 20% would be age 20. They're not in their 20s, they're in their 50s. The second one says 50-50, where half is in bonds, half is in stocks. Well, if you're in the 50s, you know, as a starting point to talk about recommendations, 50% should be in bonds. Then you kind of go from there. That wouldn't be a bad choice. 70-30 with bonds. You know, they've got 12 years to go for investments. If they got 70% in bonds, they're not going to meet their goal for the retirement goal. They need to have more in stocks than just 70-30. And the last one says 100% in government type securities. Well, we know that's going to be a low rate of return for them because it's super, super safe investments. That's not going to do the job either. So for this particular answer, we're going to go with 50-50, moderate investment. Again, that's a good starting point for someone who's moderate. You might go a little bit more in stocks, a little bit more in bonds, but for that particular person, if they're in the 50s. Again, it depends on their risk tolerance. Genevieve's an 82-year-old widow with no investment experience other than bank CDs and savings accounts. She's never invested in anything else than using products from her bank. Her primary objective is to pass along as much of her $500,000 estate as she can to her 3 children. Her secondary objective is a regular income to help support her monthly expenses. She's got a $100,000 bank CD coming this month. What mutual fund would you recommend for her? An aggressive growth stock fund? No, absolutely not for someone who's 82, and certainly not for someone who's had no investment experience other than bank type accounts. How about a balanced fund? Well, okay, 82, that means 82% should be in bonds and 18% in stock. That might be a choice, maybe a choice for her, but let's look at some more. How about a government securities fund, where everything in the fund is in United States government securities that's completely guaranteed by the government? That looks like a good choice there for her. How about a money market fund? Well, money market would certainly be a good choice for her here too. But you guys probably know the interest rate on money market funds is incredibly low right now. So she really wouldn't get the income she's looking for, because she said that was a secondary objective. She wouldn't get the income she's looking for to support her monthly expenses if she had it in a money market fund. But she would get a nice income coming in from the government securities fund. Essentially what they do is they pay dividends out from the government securities that are paying interest. So they're passing along the interest to her through a dividend. She'll get that income she's looking for. So that government securities fund would be a good choice for her here. Of these choices anyway that we had. Mrs. Thomas has owned several apartment buildings for many years. She just sold a 10-unit building that had been on the market for 6 months. She was disappointed in the profit that she made. She's considering her knowledge about real estate to invest in another type of vehicle, which would provide the opportunity of receiving income without being a landlord, where she would have to own any buildings, but she'd get income from the real estate of these buildings without actually owning the buildings themselves. What do we offer her? Well, a real estate investment trust is kind of like a mutual fund. It's not a mutual fund, but it kind of works like that, where it passes along dividends to you as income from the properties that is producing income in the fund, and they can also pass along capital gain distributions to you as well. If the real estate investment trust owns the property, the actual physical buildings that are in there, it's called an equity REIT. If they own mortgages on buildings that produce property, it's called a mortgage REIT. So a mortgage REIT can be an income producer for people. They're not going to be able to pass along capital gains to you because they're not going to be selling buildings for more than they paid for them due to the fact that they don't own any buildings in a mortgage REIT. In an equity REIT, they would. So if she's looking for something that's like owning buildings that produce income without having to own the buildings, an equity REIT would be a good choice. By the way, you have to have a Series 7 license to sell REITs to people, real estate investment trust. Another nice product you can offer if you have a Series 7 license. Mr. Jones calls you and he wants to buy 1,000 shares of stock. The only issue is that the stock is for a company that's not a United States company. The company has strong earnings and pays a dividend equal to what he would be able to receive from his domestic investments. You should explain to Mr. Jones that non-US companies don't pay US investor dividends. Well, yeah, we said companies from other countries can pay dividends to you. Investing in a company without speaking the language is not a good idea. Well, yeah, I guess there's some validity to that, but not necessarily. You wouldn't. A lot of our business world globally is in English. So my guess is he probably wouldn't have a language barrier there. Instead of purchasing shares of the company, you should consider an ADR instead. Again, ADRs are easy to buy and sell. It's much more difficult to buy and sell a physical stock of a company from another country. The ADRs is a much more liquid way to do it, a much more efficient way to do it. And the last one says it will be difficult to exchange his foreign dividend into US dollars. No, actually what will happen is his foreign dividend he receives will automatically be exchanged into US dollars, and he could lose money on that deal. If the foreign currency goes down against the dollar, US dollar is the benchmark for all the major currencies out there. If the foreign currency goes down against the dollar, they're going to lose money on that foreign currency exchange. So we do have foreign currency exchange. Yeah, ADRs would not be a bad recommendation for this guy if he's looking to purchase foreign stock. Peggy Pinchpenny has $200,000 in an investment portfolio, which is split between stocks and bonds. She's in her mid-30s, would like to diversify a portion of her stock portfolio by including companies outside the United States, but she's not sure which ones to choose, which stocks to purchase. So what should she invest in? Well, again, mutual funds or an ETF type fund. This is going to be a great choice because she has professional management who's going to pick the stocks that are going to be in there for her. So we have an international fund, we have a global fund, we have a global equity fund, and then we have a single ADR. You buy a single ADR, that's just one company. You buy a fund of companies, you're investing in many, many companies in many, many different countries in many industry, and you have way more diversification. She did say diversification was her choice, and she said that she wanted it to be diversifying stocks specifically, not bonds. So the international fund would be a good choice. A global equity fund would have US stocks in it and international stocks in it. A global bond fund has US bonds in it and international bonds in it. She said she just wanted some international stuff, so you'd have to go with the international fund for her and give her that professional management she's looking for outside the United States. Sam Shermoney has a diversified portfolio currently worth $4 million. He has an additional 100 grand and is bullish on the technology sector. Thinks the technology sector is really going to pop. Understanding the difference between sales charges and other investment related fees, he does not mind paying experts to choose the correct securities and wants to use his investment sophistication by purchasing the investment using a margin account. He wants to do a margin account. So what we're going to do for him is we're going to do an ETF for him. ETFs can be purchased in a margin account where you can pay half the money and borrow the other half from the broker dealer. If you do that and the market goes your way, you're going to get a tremendous boost in your rate of return. Can't do that with a mutual fund. You cannot do that if he buys IPO shares of a brand new company. New issues cannot be purchased on margin, but ETFs can. So he could use a sector ETF that's specifically a sector, industry sector, technology sector. He'd be able to do it and be able to buy it on margin. George Grizzly has a bearish outlook in the market. He's a savvy investor, believes the market's going to turn around. Until that happens, he would like to earn additional income from his investments, but be able to take advantage of market appreciation when the market begins to rise. So he's looking for income now, but he wants an investment that gives him income now, but also has the benefit of capital appreciation in the future, where the investment can go up over time. Preferred stock does not appreciate in value. Common stock does. Preferred stock does not. It is a good income producer, but it's not a growth product. It's not going to give him the growth he's looking for. A convertible bond, we talked about that. That's a bond of a corporation that you convert into the common stock of that corporation, the same corporation, in the future. Well, that looks like a good choice. He'd be able to participate in the appreciation, but also get interest from the bond now. U.S. Treasuries, yeah, U.S. Treasuries, those are T-bills, T-notes, T-bonds, anything that starts with a T, that's not going to grow for you. It's not going to give him the appreciation he's looking for. And a money market fund, we know, has a tremendously low rate of return. Definitely not going to be the potential appreciation of his money in that one either. So the choice here would be convertible bond. So hopefully this particular webinar gave you some insight in terms of purchasing securities out there in the marketplace. We hope it's been beneficial to you. We thank you for using Kaplan, and we wish you the best on your test. Please keep an eye out for the other webinars that are out there. And don't forget that our webinars are recorded. So you'll be able to listen to a recording. If you miss one, or if you want to go back and listen to one again, you'll always be able to do that. Thanks again. Stay safe, and we wish you all the best.